This is Jack Yeager. This video is talking at a very high level about financial stakeholders, typically for a corporation. Again, since what we're primarily talking about is corporate finance, this seems appropriate. I'll try and generalize it a little bit. And also, this is a very high level view. We will spend more time talking at a much more detailed level about these stakeholders and about the contracts that they have with the company. But right now I just need to give you enough information so that you have some context for what's going on, who I'm talking about. So the first ones we'll talk about are debt and debt holders. Very simply, debt is money the firm has borrowed. And so when I say it is borrowed, I mean that there is some expectation that something will be paid back. And that usually is the amount that was borrowed plus some sort of interest. Corporations typically borrow in the form of a bond. A bond is a little bit different than what you and I are probably used to when we go out and borrow. It's a contract between the firm and the investor. And in the contract, the firm agrees to pay some amount each year. Now, it may pay it out in multiple payments in a year, but some amount each year is interest, and then make some final, what we call maturity payment at some point in time in the future. And that could be a year from now, 5 years from now, 10 years from now. There are government bonds there are corporate bonds that are 30 years out into the future. And so that final payment isn't made until then. And so to put that in kind of a perspective for you, a bond contract usually, sort of a typical bond contract, calls for a final maturity payment of $100,000. That's called the par value or the face value on the bond. And then there is some sort of an interest amount. And so it may be stated as pays 5% interest a year. So you would take 5% of $100,000, which is $5,000, and that's how much the firm would need to pay to the investor each year is $5,000. So it would be $5,000 a year for some specified number of years, and at the end of those years, $100,000. And so that's a contract. And so the bond issue is a collection of those bond agreements that all have similar terms and are sold or issued at the same time. They are issued in that an investor purchases the bonds from the firm. So investor gives the money for the bond to the firm. The firm now has it and can use it in its business opportunities, whatever it needs to do with it or wants to do with it, whatever it financially decides to do with it. And over time, in return for having purchased the bond, the firm will make those agreed payments back to the bondholder. Because this is a transaction between the company, the firm, and an investor, this is called a primary market transaction. It's primary because the result of the transaction is that the company actually gets some money. Once the bondholder owns the bond, they can either continue to hold it for the entire life of the bond and receive the payments, or they can sell it to another investor. When they sell it, the other investor will give them some agreed amount of money, and then that investor will be entitled to the payments from there forward. When debt is resold, so from one investor to another investor, the firm's not part of the transaction. It gets no additional money or pays any additional money as part of that transaction, and so it's not really involved at all. And this is called a secondary market transaction because the firm is not part of the transaction. As far as thinking about from the perspective of a debt holder, what kind of money they're going to make and how that relates to how well the company performs, the gotcha for a debt holder is that the most that they're ever going to receive is the amount that is defined in the contract. It's not that they get whatever profits the company make, or if they do well they get money, or if they don't, they don't. It's none of that. There's just the amount that's specified in the agreement. So From a bondholder's standpoint, generally what you hope is that the firm does well enough to at least make its payments to you. Beyond that, you don't really care whether it does any better than that or not, as long as it does just well enough to make all of its payments to you. So sometimes the firm will make a bad financial decision or a series of bad financial decisions so that it may be forced to liquidate. Liquidate is a term we use when the company basically shuts down and you start selling off assets or businesses or whatever. And so you are liquidating them, turning them into cash. When this happens, the debt holders have what's called a preferred interest in the assets of the firm. So once all of the money's collected from selling things off, they're the first ones to get paid from whatever gets raised from that. And so from the standpoint of having certainty about whether or not they're going to get paid, because they have these contractually agreed payments and they're first in line if something bad happens to get paid, they are considered to be have the lowest risk of not getting paid of the shareholders. So that's a good thing for them. Also, if the firm defaults on its debt, meaning it fails to make some of the agreed contractual payments, or if it goes to a court and files for bankruptcy, then the debt holders are entitled to seize control of the company from equity investors and take over and manage the company. They don't manage the company at the outset. They don't have really any say in the company. They just are somebody that loaned it money and is entitled to payments. So the flip side of that are equity and what I will refer to as shareholders. Sometimes we'll call them shareholders. Sometimes we'll call them equity holders. Sometimes we'll call them stockholders. All those terms pretty much interchangeable. Equity is the money that an investor gives to the firm without any requirement for repayment. So when you invest in a company, you hope that the company does well. As an equity investor, you invest in a company, you hope it does well. But you don't have some right to get some payment from the company, some contractual right, if it doesn't do well. And so, there's possibility that you'll never see your money again. And quite frankly, for a lot of investors that have purchased stock from companies, they never receive any money from the company. That's just not the way things are set up. We'll talk about that a bit more in just a second. So equity is raised by issuing shares of stock. So stock is a share of stock is a contract. So like debt, it's just a contract between the firm and an investor, where the firm agrees that the investor will receive a portion of any payments made by the firm to equity investors. So if the firm decides to make payments to equity investors, you have a share of stock, and so you're entitled to your share of whatever those payments are. And then the contract may also give you certain voting rights, which allow you to vote on certain matters as it relates to the management of the firm. You don't get to vote on everything. A lot of times that voting is just you get to either vote the board of directors, you get to vote on certain very big issues for the firm, like voting to remove a CEO or something like that. But you do not really get to vote on sort of day-to-day matters of a firm typically. Just like with a bond, a stock issue is a collection of stock agreements. They have similar terms. They're sold or issued at the same time. And so you can think of in terms of a company may have multiple stock issues. They issue some stock in a batch, and then later on they issue more stock. Investors purchase the shares from the firm, and then the firm can use the money to invest in its business opportunities. So it works in that sense just like a bond. And this is also a primary market transaction because the investor's purchasing directly from the company and the company is getting money for it. The initial investor in a stock can hold the stock and receive any payments if they happen. and it gets nothing if they don't, or it can sell to another investor. When the stock's resold, again, it's the firm is in no way a party to that transaction. They don't receive any extra money, even if the value of the stock went up. And so this is called a secondary market transaction. Theoretically, the market value of a common stock should reflect the expected value of all the current and future amounts in the owner's equity account. So we'll talk a little bit more about that in just a little bit, but basically, if you think from an accounting perspective that you've got this owner's equity account, and you think in terms of that as the company has profits, those profits go as retained earnings into the owner's equity account, then eventually the stockholders are the ones who have rights on that owner's equity account, and they might, receive their share of the value that's in that. And so as a result of that, any decisions that the company makes that may change, either increase or decrease the amount of profits that can be expected to go into that account in the future, will probably change the value of the stock. Again, that's different from a debt holder. They really don't care what's in the owner's equity account. All they care about is that there's enough money to pay the debt. So stockholders, again, aren't guaranteed any specific payment from the firm, ever. It's very, very unusual in a stock contract to state that, a common stock contract, to state that you're entitled to some payment as an investor. There's another kind of stock called preferred stock. We'll cover that a little bit later on, where you may be entitled to certain payments. And again, I don't want to muddy the waters with that right now, but for common stock purposes, generally there's nothing ever written in it that says you're entitled to a payment of some amount. What you are entitled to is that if the firm ever decides to make a payment to equity, which they could do in the form of a dividend or a repurchase of some of the stock that's out in the market, then you're entitled to your share of that. So, if you kind of think it through, sometime over the life of the company, it's just going to build up all of this money in the owner's equity account, and there's this belief that it's then going to want to start distributing some of that, and that's what you're really hoping to get. If the firm makes a bad financial decision so that it's forced to liquidate, the stockholders do not have that preferred interest like the debt holders. Rather, they have what's called a residual interest in the assets. What that means is you sell off all of the assets, you get the pile of cash, you pay the debt holders first, and once all the debt holders are paid off, whatever's left gets distributed to the stockholders based on the number of shares that they have. And so if there's a lot left, that's great. Usually if there is some sort of forced liquidation, it happens because they don't expect there to be a lot left. In fact, there's a question about whether, in some cases, whether there would even be enough left to pay the debt holders. And so usually having that residual interest in the assets is, if you ever come to this situation with a company, it usually means you're not going to get hardly anything back. If the firm defaults on the debt or files for bankruptcy, same sort of scenario we talked about with the debt holders, remember that the debt holders are entitled to seize control of the firm. And what that means is that whatever voting rights that you had for your stock, that goes away from you and it gets transferred to the debt holders instead. So not only do you lose potentially in that situation all the value that you invested in the company because there's no residual value left for you, but you also lose control of the company, you lose control of the voting rights, and so effectively you lose everything. So from a kind of a shareholder perspective, the debt holders don't have as much say right at the beginning, right, when the company's doing well, and they don't really have a lot of risk associated with whether the company does very well or just sort of well. They really are only worried that the company doesn't do so poorly that it can't make its payments to them. Whereas the equity holders need the company to do not only good enough to pay the debt holders, but good enough to pay the debt holders and have money left over to put into the retained earnings account for the equity holders. So that's kind of a big thing. It means generally what we think of is that the debt holders are more worried about bad things happening. And the equity holders are more interested in what good things are you going to do for me. They understand that if bad things happen, they'll just happen. And that's pretty much it on the two kind of shareholders.